It is Monday, and that means it is time for the Real Estate Show. We go live every single Monday at 12 p.m. Eastern Standard Time. And today on the Real Estate Show, we are talking about everybody's favorite word, which is cash flow. Cash flow, cash flow, cash flow. Because without cash flow, your real estate investment dies. Cash flow is the lifeblood of real estate investing. So today I'm going to break down what exactly cash flow is, how you calculate it, all the things that go into it, and why and how it affects your real estate investment. All right, so this is going to be a cash flow centric, cash. Robbie, we need the money gun for this one. Cash flow real estate episode. So to start things off, what is cash flow? Well, cash flow is the money a real estate investment, puts out, right? Hey, you have this real estate asset right here. Cash flow, here's all the money. But it's not that simple because we have different things that bring money in, that take money out. So let me just break down the first thing we're going to cover today, which is called the NOI, or it's called the net operating income. Income. There we go. NOI, if you're doing any type of real estate investing, any type of deal, you have to understand NOI, net operating income. So it's basically broken down into two parts. On the one side, we have what's called revenue or the income. This is all the money that the property is bringing in, that the property is generating. So it could be rents, it could be laundry, it could be parking fees, trash fees, late fees, pet fees, application fees, anything like that. That's income the property is generating. So that's called your revenue or income. So I'll just say revenue. Or you know what? Let's keep it easy. We'll say income. So like I said, we got rents, laundry, etc. I just listed them all off. All right. On the other side, we have what's called operating expenses, or OPEX for short. These are all the expenses, all the charges that you incur for operating the property. So some of these, there's a long list, but you could have management fees. You could have pest control. You could have advertising for the property. You could have maintenance and repairs. You could have resurfacing the parking lot. You could have new signage for the property. All of that stuff is an operating, like repairing and fixing up the signage. Those are operating expenses. So what we do is we take our income that we're producing and we subtract the operating expenses, and that gives us our NOI, net operating income. So it's basically, hey, what's the income of the property after we take out all of those expenses, the NOI. All right, so for example, let's say we have $500,000 of income, right? So that's income. And we have operating expenses of, let's say, $400,000 for this example. So our NOI, our net operating income, would be $100,000. Now you'll notice that with our OPEX, we don't include what's called capital expenditure or capital improvements. These are one-time investments into the property that will increase the value of it. So for instance, I mentioned we have maintenance and repairs that fall into OPEX. So that could be, hey, there's a storm that comes through, some roof shingles come off, we have to repair the roof, right? That would be an operating expense. That's a repair. But if we're replacing the whole roof, that would now become a capital expenditure, capital investment. So that's treated differently, and those are not included in OPEX. That's treated differently for this, because that's not a normal cost of doing business for this property, and that's really at the owner's discretion. So if we're doing huge renovations and renovating everything, repairing a kitchen sink, that's a repair. Repairing a countertop, that's a repair. But if we're replacing the entire kitchen, that's a capital expenditure, and that's treated differently. That's not what we're covering with NOI. So we have income, subtract your operating expenses, so all the repairs, maintenance, all that stuff. That gives you your NOI. Now what we're going to do is we're going to draw a magical line, because we still don't know our cash flow. And why don't we know our cash flow? Well, we have something called debt service. So I've talked in many, many other videos about using leverage in real estate investments. So using a mortgage from the bank or another form of debt to really put gasoline on our returns. So what we have to do is we have this line. So we have our NOI. We draw this magical line. Now we take our NOI and we subtract what's called your debt service. That's a fancy word for saying, hey, how much money do you have to pay every single month for your mortgage payment or for your line of credit payment, all of that type of stuff? We have to subtract it. Because when we're running the property, we're using leverage, we're using mortgages, we have that expense. Now, you might be wondering, hey, Seth, why can't I just include that in my OPEX? Because it kind of sounds like it would, right? You've got this cost of doing business. Yeah, every month you have these fees. Why doesn't it go into OPEX? The reason is everybody chooses to use a different form of leverage. So we're really treating the property as a business at this standpoint, at this point, right? What does the business of the property look at? Debt and financing is at the owner's discretion. So one owner may choose to pay all cash for a property, in which case there would be no debt. Another owner may want to leverage that property by 50%. Another one may want to go up to 75% leverage. Now, the interest that third person is going to pay at 75% is going to be much higher than the 50% and much higher than the zero that all cash buyer is going to pay. So it doesn't really have to deal with the actual business of the property. It's at the owner's discretion. And this is why we don't include it in OPEX, right? So you've got income minus OPEX equals your NOI. Now we draw this magical line. We go below the line. And now we have your NOI minus your debt service, which is at the owner's discretion because the owner, whoever controls the property, controls what type of debt they want to use. And now at this point, we're going to get your cash flow, which is really what we're solving for. So in this example, that we had an NOI of $100,000, maybe our debt service, and this is a really bad example, I'm just making up these numbers. Maybe our debt service is $50K. So our cash flow would be $50,000, right? Because we've got our NOI of $100K and we subtract $50K, and that gives us our cash flow of $50,000. And this is the cash that is left over in your pocket at the end of the day after everything else is done. And then because, in your OPEX and stuff, we have taxes, all of that. Now, obviously not your personal tax, but the property taxes are included in your OPEX. So that is cash flow and how we solve for it. Now, why is this really, really important? Well, a number of different reasons. Number one, you have to understand if you're looking to get that debt that we were talking about to leverage the property and accelerate your returns, you have to understand how the banks view the risk and cash flow in a property. Because here, let me erase this. Because what the banks are really looking for is something called the DSCR. And that's an acronym for debt service coverage ratio. So let me just erase that. Okay, so the DSCR, debt service coverage ratio. And what does a bank want to see? They want to see your DSCR be 1.25 or above. What does this mean in real talk? This means that your property is generating enough money with a 25% buffer between having to meet all of the requirements and outlays the property has and paying back the bank. Because at the end of the day, the bank just wants their money back. They don't want to lose the money because once the bank loses money, they can't put it back out. So they want to keep that capital preservation. So they're looking for a 25% buffer between the money the property is producing and the property having to look after all of its obligations in terms of expenses and debt. Because if the bank knows that if there's that 25% buffer, that now, if the rents go down, if something happens, they've got some wiggle room where they're still safe and you can still pay them back all the time, and keep those payments going before you start getting into trouble. That's what the bank wants to see. So for you as the person acquiring this property, you have to understand your NOI and understand what that is and all the operating expenses that have to go out, and then how that impacts go below the line, and how debt service coverage, and having to pay all of those those debt service costs. You have to understand how that affects your cash flow, and hey, what's left over at the end of the day, and is that enough to satisfy most lenders' requirements of 1.25? That's really what you have to look at. So in order to get lending, to get financing for your property, you have to understand net operating income, as well as going below the line and your debt service and your debt service costs and your cash flow. And then how does that impact your DSCR? Because that lender wants, like I said, that 25% buffer. So a lot of people, and I thought this way too when I first started out, they're banking on what's called capital growth in a real estate investment. So we've got two ways that people really think about real estate. You've got investment, and then you have speculation. Now, there's a difference between the two. So let me just, we'll do this in real time. I'll pull up the dictionary app. So define investing. So according to the dictionary, so investing is expend money with the expectation of achieving a profit or material result by putting into financial plans, blah, blah, blah. That's not the one I'm looking for. More definitions. Where's it going? Okay, I'm having trouble. All right, anyways, with investing, here, let me just go to dictionary.com because this is not working. I thought it would be a lot smoother than it is being. Okay. Investing. I should have pulled this up before Robbie'd have it done, because now it's not working. And I've got ads all over the place. Anyways, all right. So I can tell you from memory that the definition of investment is you're putting money into the market, and you're going to make money through the growth or the increase in value of the asset, or interest, right? Or like payments, cash flow. That's the definition of investing. You're risking money in the market with the expectation of growing that money through, capital growth, interest, or payment. Speculation, on the other hand, rests. Well, maybe speculation will work. Let me see. Define. No, it's giving me the theory under conjecture without firm evidence. Different speculation. So with speculation is where you make money. You're counting on the growth of the asset, but you're not earning interest, you're not earning cash flow or payments. The only way you make money in this investment is if the value of the asset goes up. And this is higher risk. So why do I bring this up? And I'll call it, why did I embark upon this failed segment right now where I was trying to define it? Well, the reason is, when we look at real estate, people can take a more speculative approach, but they still think they're investing, right? And I'll tie this back into cash flow in a second, right? So when I first started in real estate, I thought that I was investing, right? You buy a property at 500K, you want to stay in the market. Hey, the market's going really solid. Pretty soon it's going to be 700K. Oh, I'm investing in real estate. Now, was I earning cash flow or anything while this asset was, let's just say I'm buying a new build, right? So I buy the contract for the new build at 500K. It's going to take a couple years to build, and then I'm banking on the property being 700K when I take possession of it, That's instant equity of $200,000. Am I earning interest during the course of me owning this piece of paper? No. Is anybody paying me? No. Am I earning rent owning this piece of paper? No. What am I doing? The only way I make money here is if the value of this thing, which is in this case the piece of paper for this new construction, this contract, it goes up. That's speculation, right? And this is where a lot of people get into trouble. I know of a couple of situations now where somebody bought on spec, right? They bought the contract, and now the value, instead of going up, is going down. So now the property is worth maybe $400K. Now what happens? You're on the hook to pay $500K because that's what the agreement you reached with the builder. But now the market's saying, oh, it's only worth $400. Now the bank, when you go to get a loan on it, the bank's not going to use $500K. They're going to use $400 because that's what it's worth right now. The bank doesn't want to extend themselves and give you and loan you money based on a value that's non-existent. So now it's worth $400K. And now what happens? Well, now you have to come up with the difference. Not the difference of $400K, but at the $500,000 value. That's the risk you run into. Investment, on the other hand, you're earning interest, you're earning payments, whatever it is, as well as the growth of the asset. So this is where, an apartment building, for instance, you own that. Now, obviously, you're going to do things to the asset. We talked about capital investment, capital expenses, where you do renovations, you can increase the value. That's one way to do it. But we're also earning rents. Every single month, people pay us rents. This is investing because it's a lot less risky than speculation over here, but also with the rents, we can increase the rents. Now that's going to improve what? Our cash flow. And this is why it ties back to cash flow. Because if we're acquiring an asset where people pay us every single month to live in it, and now through our business plan, we can improve that asset, right? We're going to do renovations. We're going to fix it up, make it look better. We're going to add amenities. We're going to make it good. We can take the rents from where they're at today. And because we're improving the asset, the market's going to value renting that place higher. And now we can raise the rents. What has this done? If we're raising the rents, and this is going back to cash flow, if I raise the rents, what's going to go up? The income the property produces every single month or every single year if you want to look at annually. So the income goes up. So remember my NOI calculation? Income minus your OPEX equals your NOI. So if I can increase the income by raising those rents, the rents go up. If I can optimize my operating expenses, so maybe when I take control of the property, I have a better handle on how to actually run the business of the property so I can make it more efficient. If I can bring my OPEX down, or even if it stays the same, my NOI at the end of the day goes up, right? Because now my rents are higher. And maybe I do a better job with advertising, decrease the turn time, so how long it takes to get a unit back up and rented. There's so many different things you can do. So my NOI is now higher. Has my debt gone up? No, because I acquired the property for X amount. I leveraged 50%. Well, it still stays the same. So my debt service costs below the line remain constant. So now that increases my cash flow. Perfect. That's what you're looking for. And then eventually down the road, once you increase the value of the asset to a certain point and you raise the rents and the cash flow, now you can go and seek additional debt. And what does that do? Well, now you can refinance the property. You can return money to yourself or your investors, put money in their pocket. And now the property can support that higher, load of debt, those increased debt service payments. And now you've got more money in your pocket. And then you can take that, use something else. You can refinance again down the road. And soon enough, you won't have any of your money in that real estate property. And this is where your returns become infinite. But everything comes back to cash flow because your property has to be able to support those debt payments. If not, you're not going to be able to get that debt. Okay. So just remember, when we're looking at cash flow is important because it makes it an investment. If you don't have cash flow, you're speculating. It's speculation, and we don't want that. Well, speculation is okay, but as long as you understand that's what you're doing. But in real estate, a lot of people think they're investing, whereas they're actually speculating because there's no cash flow, there's no payments being made, there's no interest being earned. It's just, hey, the only way I make money is if the value of the asset goes up. So we have to get on this investment side. So again, formula, income minus your OPEX equals your NOI. We go below the line. Now we take your NOI, your net to operating income, subtract your debt service, so all the payments, and that gives us your cash flow. This is what you're looking for, okay? You need that cash flow. And if you're acquiring a property and the cash flow is negative, you better have a really good plan to bring it back up. So with CPI, we invest in apartment buildings across the southeastern United States. And one of the things we're always looking for is acquiring cash flow producing assets. So they're actually making money on day one. Then we go in, improve them, and then we improve the cash flow, just like I talked about, right? We improve the income, we optimize our expenses, change things around. Now we've got a higher NOI, then we go down, and then that increases the cash flow, and that means we're able to pay our investors more money. That's our business plan in a nutshell. Okay, so if you're interested in learning more about investing in apartment buildings, you want to learn, go to theapartmentaccelerator.com. You can book a call with us, and we can actually walk you through exactly how we can help you get into the apartment building investing side of real estate. So maybe you're doing single family homes and you want to get into apartments, maybe you're doing strip malls, whatever it is, we can actually help you get on the right track specific to apartment buildings. All right, so that is cash flow in real estate. So I hope this was helpful. Use those formulae to your advantage. Understand cash flow, understand debt service coverage ratio, and I will see you tomorrow for the bullpen. See you then.